All right, let's talk about one of the most powerful and honestly most mysterious institutions on the planet, the Federal Reserve. You've definitely heard the name the Fed thrown around in the news, but what does it actually do? How do its decisions end up affecting the money in your wallet? Well, today we're going to pull back the curtain and figure it out.
I want you to just imagine for a second. What if you woke up one day, went to your bank, and the doors were locked? Forever. All your savings, just gone. Imagine an economy where massive financial panics were just a regular occurrence, wiping out businesses and jobs left and right. It sounds like a movie plot, but for a long, long time in the US, that was pretty much reality.
You see, to really get why the Fed even exists, we have to travel back in time. We need to understand the problems it was built to solve, and that means diving into an era of pretty much constant financial chaos.
Throughout the late 1800s and into the early 1900s, the American economy was just getting slammed by one crisis after another. And we're not talking about small dips. These were full-blown panics that destroyed fortunes and lives. The one that really broke the camel's back was the Panic of 1907. It was so bad it made everyone finally agree that, okay, something is seriously, fundamentally broken here.
So what was so broken? Well, for starters, there was nobody in charge of the money supply. Nobody. So the economy would swing wildly from boom to bust. Banks were failing all the time because a single rumor could start a bank run, and they just didn't have the cash on hand. And maybe most important, there was no one to call for help. No lender of last resort that could step in and provide emergency cash to stop one bank's failure from taking down the whole system. So, out of all that chaos, an idea finally took hold. In 1913, Congress passed the Federal Reserve Act, and, in doing so, they created a totally new kind of bank, one designed to finally bring some stability to the financial system.
And the way they designed the Fed is, well, it's pretty unique. It's not really a government agency, but it's not a private company either. It's this strange hybrid. The people in charge are appointed by the president, and they have to answer to Congress, but the system itself is spread out across the country through regional banks, which are actually owned by other private banks. And this whole setup was completely intentional, to try and keep short-term politics away from long-term money decisions.
So, how does this machine actually work? What are the gears inside? Well, the whole Federal Reserve System really rests on three main pillars that all work together. Let's break them down. Okay, so here are the three big parts. First, you have the Board of Governors. That's the central command in Washington, D.C. Then you've got the 12 Federal Reserve Banks, which are like the hands-on operational branches all over the country. And finally, you have the Federal Open Market Committee, or the FOMC. This is the really powerful group that makes the big decisions about money in our economy. First step, the Board of Governors. Think of this as the head office, located in Washington. It's made up of 7 people, called governors, and each one is picked by the president and then has to be approved by the Senate. And remember that whole idea of keeping politics out of it? Well, here's how they do it. These governors serve for 14 years, a 14-year term. That's not a typo. The whole point is so they can make tough, maybe unpopular economic calls without having to worry about who's going to be president next election cycle.
The second pillar is that network of 12 regional Fed banks. These are the boots on the ground, in big cities like New York, Chicago, and San Francisco. They're kind of like the banker's bank. They provide services to your local commercial bank, they make sure cash gets where it needs to go, and they're constantly researching what's actually happening in their corner of the economy.
And that brings us to the third, and you could argue the most powerful pillar of all, the Federal Open Market Committee, the FOMC. If the Fed has a nerve center where the biggest decisions are made, this is it. These are the folks who are in charge of what we call monetary policy. So, when you put it all together, the Fed is juggling 5 huge jobs. It prints our cash, it's the bank for the US government itself, it's the bank for other banks, it supervises the whole banking system to keep it safe, and, this is the big one, it controls the supply of money to try and steer the economy. Yeah, that last job, controlling the money supply, that's where the Fed's real power comes from. It's like they have their hands on these giant levers that can steer the entire US economy. So, let's look at the tools they actually use to do it. Now, the Fed isn't just winging it. Congress gave it a very specific job description, and it's known as the dual mandate. It has 2 main goals. 1, maximum employment, which basically means helping as many people who want a job have a job. And 2, price stability, which means keeping inflation under control so your money is worth about the same tomorrow as it is today. And let me tell you, balancing those 2 goals is a constant tightrope walk. To pull off that balancing act, the FOMC has 3 main tools in its toolbox. The biggest and most used one is called open market operations. That's just a fancy way of saying they buy and sell government bonds. When the Fed buys bonds, it's pumping money into the system, hitting the gas. When it sells them, it's pulling money out, hitting the brakes. The second tool is the discount rate. That's the interest rate the Fed charges banks for short-term loans. Lower it, and it encourages banks to lend more. And finally, there are reserve requirements. That's the slice of your deposits that banks have to keep on hand and can't lend out. By changing that number, the Fed can directly control how much lending power banks have.
Okay. That was a lot of history and structure and tools, but let's get to the real question. Why should you actually care about any of this? Well, let's connect all these big abstract ideas directly to your life.
Probably the best way to think about it is this. The Fed is the backbone of our financial system. It provides the core stability that everything else is built on top of. It's the kind of stability that we just take for granted every day, but without this central structure, it just wouldn't be there.
Think about it. When the Fed changes interest rates, that decision trickles all the way down to the rate on your car loan, your student debt, your mortgage. Their battle with inflation directly impacts the price you pay for gas and groceries. Their goal of maximum employment affects how easy or hard it is to find a job. I mean, nearly every single major part of your financial life is touched by what the Fed decides to do.
And you never see its importance more clearly than when things go wrong. During massive crises like the 2008 financial meltdown or the shock from the COVID-19 pandemic, the Fed becomes that lender of last resort we talked about earlier. It turns into the ultimate financial fighter, rushing in to prevent a complete and total economic collapse.
So there you have it. The Fed is this incredibly powerful, intentionally independent institution that manages our massive economy with a kind of surgical precision. But that leaves us with one final, very important question to think about. If the Fed is in charge of managing the economy, who exactly is in charge of managing the Fed?